38 reasons why an IUL knocks the socks off of traditional advice. In this episode, I'm going to disclose and answer the question, what is an IUL account? Get ready. I'm going to frankly overwhelm you, and hopefully you'll be interested in receiving a free copy of my most recent best-selling book called The Laser Fund, which is a properly structured and maximum funded indexed universal life insurance policy or account, an IUL. Unfortunately, the vast majority of IUL policies that are sold and owned in America are not structured correctly and funded properly to do what I'm going to show you here. If they are, then they would be deemed a laser fund. Laser, that's an acronym that stands for Liquid Asset Safely Earning Returns. And so when it's structured correctly, you have tremendous liquidity, safety, you earn predictable rates of return, and it's tax-free. And if you do it correctly, it'll knock the socks off of any other, but there's like 38 different huge benefits that most Americans are never shown. And frankly, a lot of financial advisors don't understand. So I've been a financial strategist and retirement planning specialist for more than 48 and a half years, helping people optimize assets and minimize tax. And in doing that, I've talked over 90,000 hours in front of audiences, and many times I'll do this. I'll say, folks, you're all familiar with this product. Explain or yell out some uses for baking soda. Now, invariably, the women in the audience will speak up first, and they'll yell out, well, you can soak in the tub, or you can take the odor out of the refrigerator, or you can take the pop out of a pot of beans when you're cooking beans, or whatever, okay? And then the man will usually say, well, I clean my battery terminals with that stuff. Yep. And then finally, somebody goes, oh, it's good for baking. The obvious. So what's my point? For years, I have been helping my clients optimize assets and minimize tax by using life insurance for life. Most financial advisors use it for death. In other words, they say, oh, you just should, buy term insurance and invest the difference because you want to invest to get a good rate of return over here. And you only use life insurance to pay off when you die. And so, you want to protect yourself so that if you did happen to die sooner than later with an untimely death, as we call that, your spouse, your kids that you leave behind would have had the lifestyle, piano lessons, gone to school and college and what have you, that you would have provided had you stayed around. And so basically, if you're in your 30s and you have 2, 3 children or whatever, most insurance companies will let you have life insurance up to maybe 30 times your income. If you're making $100,000 a year, you might qualify for as much as $3 million of life insurance. Now, a lot of people don't understand that. You can't just go in and apply for $1 bazillion of life insurance. You have to have the money to pay for it, but there's even cults that would provide millions to get you to do that, and then you could be a hero by strapping a bomb around your waist. There are crazy organizations and cults out there that would do that. So insurance companies will only insure you for up to a factor times your income when you're younger. When you're older, they can still use that, but they'll also insure you maybe up to 1 times your net worth. So if you're 60, they may only let you get insurance of maybe 12 times your income instead of 30. But because if you died at age 60, most of your kids will probably be out of the nest by then, so you don't have to worry about that. And your spouse has fewer years left in their life, and so you don't need as much. You only need about maybe 12 or 15 times your income, and your income's probably much greater. Or they'll let you insure yourself for maybe 100% of your net worth. If you're worth $1 million, they'll insure you for $1 million, no questions asked. But if it's $5 million, you qualify for $5 million. Now, some people think, well, why would I own that if I don't need it? You got to look at what it does instead of what it is, because for years I've been using life insurance for living benefits, not just the death benefit. And this was actually the idea or the brainchild behind E.F. Hutton in 1980 when they introduced max-funded universal life. Their objective was, let's use life insurance for living benefits. Instead of trying to get X amount of insurance for the least or cheapest premium, let's flip it. Let's take the least amount of insurance the IRS will let us get away with and put in the most premium the IRS allows, and it turns into a tax-free cash cow. If you wanted to invest $500,000, you could buy $1 bazillion, a ton of life insurance for $500,000. No, you take the least amount. So when you're doing what I'm talking about, if you were 60 years old and you had $500,000, the minimum amount of insurance is only $1 million. Now, who pays $500,000 for $1 million? Well, people who want to use it for living benefits do. When it was first introduced, you put in $500,000 back in 1980. Clear till 1990, I never got credited less than 11.75% on my universal life. I earned as much as 15.5%. But let's round it down to 11. I was earning 11 and netting 10. I had many clients who put in $500,000. They were earning 11, netting 10, and they pulled out $50,000 a year tax-free. It was totally tax-free. Because money inside of an insurance contract for over 108 years now is a sacred cow. It accumulates your money tax-free under Section 72E of the code, if you're wondering, and you can access money tax-free. So when they put in $500,000 and started pulling out $50,000 a year, the interest, it was totally tax-free under Section 7702 of the code, because they were able to structure the policy with the least amount of death benefit and to put in the most money because their objective was for life, living benefits, tax-free income. But when they died, the $500,000 would blossom to a higher amount, but it would double to $1 million. But if you leave it in there to grow, that $500,000 grows, and many of my clients with indexed universal life, which was introduced later in 1997, they have earned 11 and netted 10 still to this day, because indexed universal life was introduced when interest rates started to come down, and that allowed people to be able to participate without your money at risk in the market by linking your returns to an index. But if that index or the S&P or the Dow Jones, whatever thing you linked it to, went down, you didn't lose. The options expired worthless. But where did they get the money to buy options? The insurance company, you relinquished the interest on your money. So $500,000 normally was able to earn rates of return still of 11.17 netting over 10%. Even going back to 1980, before indexing came out, I've averaged 9.62% on universal life combined with index universal life. Let's round that down to 9.6. If you understand rule of 72 math, you divide 9.6% into 72, your money will double every 7.5 years. Yep. We've had many people, their money has doubled in 7.5 years. $500,000 doubled to $1 million in 7.5 years. Now, let's say you have $1 million and you're starting to take out that income. Well, see, for living benefits, they can use this for all kinds of goals. What I've been talking about, it becomes the dream solution, and I call it the financial Swiss Army knife in my books. And I want to gift you a copy of this because you can use it for the death benefit, but that's the secondary objective. You want the least death benefit the IRS will let you get away with, and you want to put in the most money for what? Retirement planning. So that you can accumulate $1 million. Every million can generate 80, 90, $100,000 a year of tax-free income from age 65 if you live to be 120 without depleting principal, based on actual historical rates of return in this instrument called IUL. If it's structured correctly and funded properly and you rebalance, it's deemed what I call a laser fund. But when people see that, they go, well, could I do this in lieu of a 529 college savings plan? Absolutely. In fact, why would you mess around with one of those? If your child doesn't need that money, they have to pay tax on it if they got a scholarship and they want to use the money for a down payment on a home or to start a business. Why would you put it into a laser fund and it's tax-free and you take it out as tax-free for whatever reason you need. What about working capital for business? Business owners go, well, could I just keep my money in here from my business working capital when I need to buy some inventory or do something? Could I access money? Yeah, you could borrow it out at like 2%, or you could borrow. Why would I borrow my money? Why don't I just withdraw it? Because if you borrow it at 2 or 5%, you'll keep earning maybe 9, 10, 11, or 12%. Would you borrow money and pay 5% if you could keep earning 10? Yeah. Would you hire an employee for $50,000 a year that made you an extra $100,000? And all of a sudden, business people get it and they want to use it for a working capital account. Same thing for real estate managers that own rental properties. It's way better than an emergency fund. You put your money in one of these. The safety rating is usually 4 or 5 notches, sometimes 6 notches higher than most banks and credit unions, AAA compared to BBB. And the rate of return goes from 1% in the bank to even just 5% if you don't even link to an index. You can earn 5 times as much money and have 5 times the safety, or 5 notches higher in safety, rather, by having this as your emergency fund. If you have lump sums for capital transfer, if you're using it for estate planning, if you're a school teacher, police officer, a firefighter, or you have a defined benefit pension, take the no survivor benefit. Don't let them talk you into a reduced amount so that your spouse will continue to get your benefit if you happen to predecease them. No, you want to take that differential, get the full amount, and put it into one of these, and you'll have way more flexibility. And your spouse, if your spouse dies first and you remarry, you're not disinheriting them, nor your children that you would be doing if you took out the state's pension under a survivor benefit. General tax reduction principles. So I want you to learn and study all the benefits of this, and here's why. When you begin to understand everything that's disclosed in this gift I'm going to give you, if you count them up, there's 38 major benefits. Now, there's some sub-benefits here. Liquidity, you can access your money when you need it. Safety, not only safety of the institution, but safety of principal. If the market goes down, you don't lose. You may not make anything that year, but you don't lose. And any year that you make money, that becomes newly protected principal. You will never lose in future years money you made in past years based on the market going down. You will not lose due to that market volatility. That's safety, and you earn predictable rates of return, some years as high as 25 and maybe 61%, like many of our clients did last year. But we're talking about average returns of 7 to 10%. Tax-free. These are the tax benefits, okay? And not just tax-deferred. But there's a lot of legal advantages because it's very hard to sue somebody for the money inside their insurance policy. Did you know that? And the death benefit at the end of the day is totally income tax-free. This is the only vehicle in the Internal Revenue Code that allows you to accumulate money tax-free. You can access it tax-free. When you die, it blossoms, increases, and transfers income tax-free. And that doesn't cost me anything. It's not free, but it's being paid for with a minuscule portion of money that most people pay out in unnecessary tax. So this is a mind map. In liquidity, you'll understand it doesn't matter if you need it because of job loss, emergencies. This is an alternative to CDs, money markets, paying way higher interest. It's an alternative to an annuity, alternative to IRAs and 401ks and so forth that are going to be taxed. You have the ability to be able to not pay tax on any of that money when you take it out. You can manage all of these blades on the financial Swiss Army knife, but with IUL, your money is safe due to the market volatility, which is going to continue to happen. And you have this peace of mind. This is why many retirees love this, because they don't have to worry about timing the market or having to slow down or stop taking retirement income until the market bounces back. Wall Street was not designed to create predictable income. The rate of return. You don't have to have pie in the sky rates of return, but there are periods where you will earn 16 and 25 and 61%. We had some clients lock in gains last year of 158% using multipliers. The key is when the market goes down, you don't lose. So the average rates of return are normally, between 8 to 10%. But if you rebalance every year or two, then that's where you can tweak them to earn more like 11 and net 10, which is what I've done. That's why I point my students to professionals that will show you how to do that. But the death benefit is tax-free. It protects your creditors. Creditors can't come and grab that. Okay, it's creditor proof. You can, unless you named some creditor as the beneficiary of your life insurance. But the death benefit is totally tax-free. It blossoms when you die. The legal advantages for your estate planning, and if you have money inside of an insurance contract, it's next to impossible to penetrate in lawsuits. And I can't go into all the details right now, but if you want to have the utmost 38 advantages, okay, over where most people have their money, they don't have those advantages. You need to learn why this all comes back to this. It's a max funded indexed universal life insurance contract structured correctly and funded properly. If it is, it will be deemed a laser fund, liquid assets, safely earning returns. Okay? And conservatively, every million that you have in one of these can generate 80 to 100,000 a year of tax-free income if you live from age 60 to age 120 with that income. Most IRAs and 401ks will be out of money in about 11 to 15 years due to the negative impact of taxes, inflation, and market volatility. On this channel, I show you how to eliminate those dangers, and it's also disclosed in this book. How do you get a copy? Now, I require some skin in the game. You go to laserfund.com, laserfund.com, click on the link below. You contribute a nominal amount towards the shipping and handling, okay? I'll cover the rest of that cost, and I'll pay for the book and fire out a copy to you. It's 300 pages of charts, graphs, and explanations. You flip it over, and this side has about 100 pages, 12 chapters with 62, chicken soup for the financial soul stories of how this financial Swiss Army knife works, okay? But this is about you and your brighter future. When you're in there, there's options if you like to listen and learn and watch and learn, but check out the free educational webinars we do on a regular basis. And also, you can actually fill in an appointment to talk to an IUL specialist if you'd like to see how a laser fund could be designed for your particular set of circumstances so that you can have those 38 benefits that I alluded to.